When I talk about fiscal dominance, I'm talking about moving away from a credit-driven economy towards a fiscal-driven economy. And all that means is that government spending is now, or increasingly, the source of economic growth, as opposed to credit creation that used to come from the bank. As long as fiscal can continue what it's doing, as long as we can continue generating more money through fiscal, then that kind of de-risks the rest of the economy and makes things less brittle. Where we're going next with fiat, I think, is really extraordinary. The idea here is that as we transition into a new phase of an economy, these old economic metrics will start throwing off bad signals. If we are progressing towards post-scarcity, and if we are progressing to a world where AI increasingly automates labor, and the relationship between time, labor, and money become dissolved, right? Those things are no longer scarce, then
Ben Kizemchuk is a portfolio manager at Wellington Altus, helping high net worth clients grow and protect their wealth.
Known for his innovative client-first approach, Ben advises families, professionals, and business owners with full-service, personalized strategies.
So I think in terms of the very practical application of these ideas in terms of today's investment world is you got to be very careful about owning bonds. I would also encourage investors to look more from a trend following point of view and not from a mean reversion point of view. But more broadly, gold, Bitcoin, equity markets, the things that I would emphasize there are that, looking at things that have fixed supply where you can't make more of that, I think that's still a very relevant investment theme today.
Hey guys, I just wanted to let you know, I published a new book, The Bitcoin Enlightenment, co-written with my buddy Daniel and none other than Mexican billionaire Ricardo Salinas. It's a deep dive into the monetary system and its future. In it, we make the type of connections that go beyond what you'll hear from your average Bitcoiner, MMT advocate, or macro pundit. So grab your copy on Amazon today. You'll find the link in the show notes. And now on to today's show. Hey guys, welcome back to Less Noise, More Signal. This is gonna get quite hot here, the discussion. I know the weather here in Switzerland is quite hot, but I'm really looking forward to this discussion as well, which I think is gonna be a really hot one. So I have Ben Kizemchuk today with me. You're from Canada. Thanks for stopping by.
Thank you so much, Pascal. I appreciate the invite and looking forward to our chat today.
Yes, exactly. So I really hope that I will make it in this room because it feels like 30 degrees in here. We really have this heat shock wave going through Europe. I'm not sure about Canada. What's the weather like over there?
It is a beautiful sunny day outside. No complaints over here on our side. Beautiful.
Okay, nice. Yeah, I can't complain either because I prefer the hot weather over the cold one. But still, like if it's that hot, usually it wears you down. But still, I'm really excited for this discussion. I told you already privately, you're probably the most high signal person currently that I'm following on X. And so that's why I really wanted to bring you on. You have so many interesting takes, especially when it comes to how the world really works today. And I want to get into all of this. But maybe before we start, could you quickly introduce yourself?
Yeah, sure. I'd be happy to. Thanks, Pascal. So I'm a portfolio manager at a firm called Wellington Altus Private Wealth. We are Canada's top-rated investment dealer for, I think, 6 years in a row now. And my background has really been in wealth management for a very, very long time. I grew up in a family of wealth management. Big influences from my father, my uncle growing up. I mean, these were topics that we talked about on the dining room table all of the time. So I've been thinking about this stuff for a very, very long time. More formally, I'm the guy who literally started in the mailroom when I was like 18 or 19 years old. I won Canada's largest stakes. And then I worked my way up through the various back office roles and positions. Started managing money in 2010 and came off to a very strong start. Won a bunch of Rookie of the Year awards, kind of things like that in my early days. And then left the bank and started working with my father and his partners in 2013. And that was a lot of fun. That was a lot more entrepreneurial. That was a lot more all hands on deck, I'll call it. And then in 2017, our firm went through a tremendous merger to become Wellington Altus Private Wealth. I think back then we were managing something like, 500 million dollars, something like that. And these days we're coming up just shy of $40 billion in assets under management at the firm level. So it's been quite an exceptional rocket ship of momentum, and been able to work with some incredible and very talented mentors and people along the way.
Yes, and so I mean, this sounds like a really interesting background as well that you're having here, given that you've been in the financial sector for so long, and then also, with the background of your father and your uncle being exposed to finance, and so yeah, you must have seen firsthand how things have changed, also by talking to your dad and your uncle. And this is something I would like to talk to you about because I feel like this is a topic that you are all over about, and on X you had a couple of posts that you also sent along for me to study, how we're moving into this new regime, and that's really what I want to talk about. So maybe I'm not sure where you want to start with that. Well, yeah, what's the backdrop of your recent post, so to say?
Yeah, sure. So, what I'm really trying to get across is this idea of the four Fs, right? And this is kind of its very own thing. It's its own regime. It's not quite the late stage industrial capitalism that everybody has been used to, particularly over like the last 40 years, I'll say. And it's not quite in this new stage where we're going to, where it's like an AI economy or post-scarcity is one word to describe it. It's kind of right in the middle. And it kind of talks about a transition phase. Like, how do we move from industrial capitalism into an AI economy? Because that's going to have all sorts of different ramifications. And that's a transition state. That's a phase change. And so the four Fs is my attempt to kind of describe what that looks like, how that feels, and some of the things that we should be paying attention to as we move into this new phase of economic growth. Okay? And the four Fs is really, well, I'll just list them, right? And then we can get into what they each mean, right? So the first thing that we should be looking at is fiscal dominance. Okay. The next thing would be financial repression. The third one is passive flows. All right. And then the fourth one is fiat. Okay. And I'll say that each of these has been a standalone idea for a very long time. And we've seen various aspects of these ideas historically, right, and geographically, right, outside of the developed market. We've seen these ideas at work. But one thing that's truly unique, I'll say, is that we haven't seen these four ideas together at the same time or the same place, and their combination today is what makes this period of time truly unique. Okay, so. So, I mean, let's just get into it, right? So the first one, fiscal dominance. What does that mean, right? When I talk about fiscal dominance, I'm talking about moving away from a credit-driven economy towards a fiscal-driven economy. And all that means is that government spending is now, or increasingly, the source of economic growth, as opposed to credit creation that used to come from the banks. Okay, so if we go back and we look at the last 40, 50 years, let's say, like 1980 until the mid 2010s, that was the economy being powered by credit, right? The Federal Reserve would lower interest rates, banks would lend more, and that money creation from the bank side would power all sorts of economic. All right.
I guess this is also where the capital market comes in, right? Like I think you've written that capital markets sort of were there to finance the growth, in terms of like the banks or extending credit, probably also through these sorts of markets, right?
Yeah. So the purpose behind capital markets, almost since the invention of capital markets, has been to finance growth, right? And then commensurate with that is also, the idea of like price discovery. Like, we need to find out what the price of these various assets are so that we can price growth appropriately. What I'm arguing that is changing is that we are moving away from the purpose of those markets to finance growth, right? Because if this growth can now come more from government and increasingly from government, and maybe in the future, perhaps we end up in some sort of recursive economy where capital kind of finances itself, and that's a concept we can get into, that maybe the point of the market in this new kind of organization is simply to coordinate fiscal flows. And it's not so much price discovery, it's more so a utility. It just kind of forms a foundational layer from which everything else can grow from, right? So that layer can then enable AI capitalism, so to speak. That layer is what helps post-scarcity become an eventuality in the market, okay? So that fiscal dominance idea is the government kind of taking the baton for economic growth and running with it, okay? The easiest example of this is we can point to, when the Federal Reserve raised interest rates by like 500 basis points in a year, everybody was expecting a massive recession. The yield curve inverted, all the rest of it, the Somme rule came, all this kind of stuff happened as a result of Fed raising interest rates, and there was no recession. And the reason there was no recession is because as the Fed raised interest rates, the Treasury then had to start paying out more money, and paying out all that money to bondholders. And when that money enters the private sector, that is what enables the economic growth to happen, right? That flow of money is the really important thing in terms of looking at economic growth. As long as that money is flowing, the economy can grow, right? It doesn't matter necessarily whether that money is coming from banks or from government. The important thing is that it keeps flowing. Interrupting that flow or causes recessions.
Yes, exactly. Yeah, I see. And one thing that you wrote, which sort of piqued my interest as well, and I know if maybe it's too much into the nuances, but you were writing that, as I said, it's no longer the capital markets that are sort of funding growth, but they are here to monetize fiscal policy. And can you go into more detail? How does that work? So what is the rationale here? How do they monetize fiscal policy?
Yeah, so monetize is one word you could use to describe it. I think an easier word would be absorb, right? And so the government is printing a lot of money. Okay, everybody kind of figured that part out, and all that money has to be held somewhere. At the end of the day, somebody has to hold that dollar, somebody has to hold that bond, etc. And what that means is that as that money grows, it has to be absorbed somewhere, right? So we have to build kind of buckets, so to speak, that can then capture all that money and keep it. If the markets cannot do that effectively, then we have what starts to become an inflation problem. Okay, so things start to run away and things can feed back very quickly, and so we want to avoid that. So the extent that we can go around building these kind of heat sinks, in a way, to use a term from like chip making and all that and computers. If we can build these heat sinks to absorb those capital flows, then the system can continue on running on a fairly like stable, lower volatility type of trajectory. Okay. So I think we're seeing that for example, that kind of feeds into the idea of the financial repression. So maybe we'll talk about that in context of the second act, right? So financial repression is this idea where the state is directly intervening in markets, right? And what the goal of that would be to lower interest rates, right? Or at least keep a lid on interest rates relative to economic growth. Now, I don't believe that that's what has to happen. So personally, I don't think that you need to keep a lid on interest rates. I don't think interest rates need to be lower. The economy is doing just fine today without lower interest rates. However, the current set of policymakers that we have in place, these guys all went to school and all grew up in a world where you had a different type of an economy, right? And some of these were even trained like even before fiat economics became a thing. So they still think that like gold standard rules apply to our current economy, even though they don't. And so they take that thinking with them. And that thinking, that style of thinking would be telling them today that we have a deficit problem, that we have a debt problem that needs to be addressed. So even though I don't think this is an issue, they do. And so they are setting policy based on that idea. So that's where the financial repression comes into play. So what you're trying to do, if you think that you have a debt problem, one way to get out of it would be to inflate your way out. But how do you do that without absolutely crashing an economy? Well, you would try to put a level on interest rates, put a ceiling on interest rates, and let inflation and growth come up above that level. Okay? Because if you can grow your way out of debt, which is kind of the plan right now, I'll say, then you can kind of use that nominal expansion to kind of grow your way out, and that's it, right? Your debt problem's gone, and your economy can keep going. And so one way that they're doing that right now is, the Stablecoin Act, the Genius Act that's just come out, is one kind of angle on this. Another is, well, why don't we remove the SLR, the supplementary leverage ratio, and we'll let the banks lend more. $600 to $700 billion more lending could potentially happen if you're to remove the SLR. And this all opens up new places to put that money. So I was talking before about the government needs places to put money. They need somebody to hold that money. They need somebody, dollars, the bonds, etc. Financial repression is the mechanism by which that happens.
This show is brought to you by NewHedge. In a market driven by complexity, insight is everything. NewHedge is a dedicated Bitcoin analytics and intelligence platform delivering cutting-edge analysis, on-chain metrics, and real-time market data. With 200 plus proprietary indicators, live derivatives data, and adoption metrics, NewHedge provides the depth and precision that serious market participants demand. Backed by some of Bitcoin's most prolific investors, NewHedge connects traditional finance with Bitcoin's evolving landscape. Gain your data edge today. Sign up for free now at newhedge.io and get 50% off your advanced subscription with the code SIGNAL. Yeah, I see. Because just to sort of chime in here, I think the idea that you're subscribing to then as well is with these heat buckets, that we need to create, or heat sinks, in the end, that these buckets that absorb that type of money that's sort of created by government, because by virtue it can just create the money, It reminds me of this idea also during World War II, where people are sort of like, okay, we can just as a central bank or as a government, we can create the money. This is not the problem because we are monetarily sovereign. But then the problem is really the inflation that could sort of really go havoc or run havoc, and that's why we need to sort of control this. And the way they did it back then was really they created this patriotism and nationalism around war bonds, and you buy them. And it's probably not that they had to buy the war bonds because the government could have created the money anyways, but it created these buckets where the money could flow into, and there it was maybe through the patriotism, as I said. Today it's more through regulation and then stablecoin acts and stuff like this. But I guess that's similar to this, right? That you're explaining this here.
Yeah, I think the other really interesting aspect out of that, especially looking at World War II, was the direct aftermath of World War II, where you had, in that circumstance, you had a Federal Reserve that was directly subservient to Treasury. And that was something that they all figured out. That's how that economy was going to work during the war. Now, the most fascinating part of that for me was that in 1951, we get the Treasury Fed Accord, which literally divorces that relationship. It splits that, and then the Fed becomes independent again. Well, that was fiscal dominance. During the war, that was fiscal dominance. The Fed was subservient to the Treasury. That is the definition of fiscal dominance. And so coming out of that was when we first saw this kind of like this current idea that we have today about Fed independence. Like Trump is challenging Powell all the time now, every day almost. That idea of an independent Fed really was something that came out of World War II in 1951 to deal with the financial ramifications of paying for a war. Today, our fiscal dominance is different because it's not necessarily coordinated ahead of time. Like there was no agreement that the Fed was going to raise interest rates, and so the Treasury was going to pay more, and that was going to solve the economic growth problem in 2022 and 2023. Like none of that was decided beforehand. This is almost like some sort of emergent behavior, almost like hive mind. Everything's kind of come together to generate this type of a phase transition. Okay, so
Mm.
that's a really important difference from the World War II experience, I think.
Yes, I see. I understand. Yes. But coming back to the repression type of thing, like the financial repression, one question that I would have there is also like repression really sounds like force, like it's really forced upon us, maybe in a slight roundabout way as well. But I mean, in the end, the question is, it's probably a mixture of everything. It's sort of regulation, and then you can say, yeah, this is sort of channeled, and maybe it's through state coercion in the end. But then maybe it's also maybe some more straightforward force that's being applied here. But then at the same time, it's maybe also just because it sort of makes sense, that we create these buckets, and then people like sort of voluntarily put their money there, because one thing that just comes to mind, and I don't know if it's related, being in Switzerland, we always had these negative interest rates, like with government bonds. And then people were like, no rational human being would ever hold a negative yielding bond. It doesn't make sense. It just needs to be forced on you. But then if you're part of a system and you have capital to deploy, and you have nothing else, and it's still your safest bet, even though you're losing out, you happily deploy that money, and so it wasn't even so sort of outright force that these people were all forced into holding these sort of instruments. And so I'm not sure if you do get what I'm trying to get at with this question, but it's like financial repression always sounds like a really bad thing and is made out to be. Is it really that bad, or how do you look at this?
Yeah, so that's a really great question. So I don't see it as being necessarily a bad thing. I mean, there's pros and cons to any kind of a policy. That's the first thing that any investor would naturally understand. The thing about financial repression and this idea is that it does, in my opinion, lead to a suppression of volatility. Okay, I think that if you can put a ceiling on interest rates, and that's effective and it works. So let's say the point of this isn't to lower rates, like Trump says, oh, we want like 1% rates or something, but I'm not sure that's going to happen. But let's just say that rates don't move any higher than 4.5. Maybe that's where we end up on this whole financial repression idea. And let's say that under that circumstances, you can continue to generate nominal GDP growth of 6.5 or 7, right? Well, if you can borrow at 4.5, or let's say 4.75, or even 5, okay, and you can reinvest, you can invest that money into GDP growth, something growing at 5 or 7%. Well, that's a great rate of return for somebody, right? Those banks are going to make a ton of money doing that business all day long, and that enables a wider economic growth to happen under the 4S regime, right?
Yes.
So I think that there is some purpose there. There is an idea there that works. I think that, as I said before, I think that economic growth could happen regardless of where you put interest rates right now, right? Because I do think that under, like, using more of like a Fisher type of idea, that nominal GDP growth should be somewhere around, whatever the 10-year bond is, give or take a little bit, right? But if the government wants to kind of put its foot down on interest rates and create a spread of, like, essentially like an arbitrage opportunity for the private sector, I mean, the private sector it's not just going to sit there and let somebody else have it. That will be explored, right? There will be people putting money to.
Yeah, no, for sure. I understand. Well, I want to come back to the interest rate discussion for sure, especially given, as you alluded to it yourself, like Trump is actually wanting to lower these interest rates, and wants to go sort of back to this private lending regime, even though that you're now arguing we're actually just moving away from this. But I want to come back to this later, and I also want to come back to the consequences that this 4F regime really has on society and finance at large. But maybe we have to spell out the other two F's still.
Yeah,
So the
let's go.
flows
Okay,
compartment and the fiat compartment. Yeah.
yeah. So let's get into passive flows. Okay, so first off, I gotta give accolades where it's due. Mike Green is kind of the master of looking at passive flows. If you haven't explored his work, I would highly, highly suggest that you look into it. And basically, the idea of passive flows is that increasingly now markets are being driven by flows and less by valuation, call it. Okay. The amount of money that is going into, 401k products, various retirement plans, automatic contributions, this type of thing is all being invested in such a way that it just follows the index. All right. So you put the money in there and it's just goes into an index product. There's nobody on the other end of that that's sitting there saying, oh, well, I think Apple is worth more than NVIDIA, therefore we should buy more Apple. Or I think Microsoft cash flows are going to go up more than Google's. Like, none of that work's being done. The only rubric there, the only schematic that's being followed is if money is going into this passive flow indexing idea, that money, that dollar is going to buy proportionally more of the largest companies and proportionally less of the smallest companies. And on the surface, that's a reasonable thing. That's okay. But the issue comes if you keep doing this over and over and over again, you introduce a feedback effect into the market. And what ends up happening is the largest companies get larger and larger and larger on a relative basis, and the smaller companies get smaller and smaller and smaller on a relative. You end up kind of introducing this bifurcation into markets. And ultimately, this is kind of, this is a way of describing kind of how it's been working. But ultimately, if you zoom out, what passive flows really mean is that the market investment is happening automatically, right? It doesn't really matter how it's happening, but it's happening automatically, okay? And that's where we're starting to bridge the world into looking at AI and automation. Investment is increasingly being done in this kind of new automated framework, right? It just happens that automation is index investing, as we know today. But the point is that it's automated, all right? And as we're moving, as younger generations, people our age, their retirement savings are pretty much all just going into these passive investment ideas, right? So if you map that forward a generation, then what does that look, right? So right now we're about 50% penetration of passive investment. Within a generation, we could see the entire market being driven completely in an automated way. That has very, very deep implications for markets and the economy.
Yeah, that's very interesting. I mean, that's exactly what I'm seeing with my friends as well. Like a lot of people who are not into finance, but nowadays it's obviously the talk of the town that everyone has to keep investing their money, because otherwise it's going to be eaten away by inflation. And so that's why everyone is flocking onto markets, but then they are no experts at all, even like experts or being expert or no expert. I mean, it doesn't mean that you allocate money that much more proficiently. But still, I mean, in the end, they are all going through these passive index funds, in ETFs, because they're so like cheaper also and more affordable, and that's why they do it. And so that's already what I can see there. And then there's discussion of like maybe you create a piggy bank style ETF investment vehicle for your kids already, just because like the compounding effect, and you want to start as early as possible. And these things are being discussed as well. So you can really see this sort of development towards passive flows.
Well, one thing I'd like to add to that, Pascal, you mentioned something really interesting about millennials, specifically, our generation and our savings preferences, our investment preference. Keep in mind that the millennial generation is not participating in the housing market the same way that other generations have. So we all have to put our money somewhere else. If we're not putting into houses, then what are we going to put it in, right? And so that's where you're starting to see this big growth in crypto and in traditional equity markets also, right? Now, the other thing you mentioned there about this piggy bank idea, right? So I think what you're talking about is this new policy proposal where every kid that's born in the U.S. will get like $1,000 or something to invest, okay? I think that's absolutely fascinating, okay? I think that is going to hasten the speed with which the post-scarcity economics comes in. That kind of continues this trajectory we've been on of equity market participation. for the general public. Like if you go back to 1980, like 30% of people had some sort of market investment, right? We're now up somewhere 50 to 60%, depending on your research source, right? But if you start giving every kid that's born an investment account, you're going to end up within a generation or two with nearly ubiquitous equity market exposure. And at that point, equity markets are no longer about price discovery. It's a utility. Okay. At that point, your equity market is simply a utility for some sort of broad market ownership.
Yeah, exactly. Yeah, because that's where what I would like to talk about as well, the implications of specifically this, like these passive flows that are increasing ever more. Because like I remember I told you offline sort of about my background as a journalist covering the passive ETF industry and everything. And one argument that came across quite often, or that I came across quite often, was like, this whole ETF industry, it's sort of the Marxist way of finance. It's really socialism that is creeping back in through the back door. Because everything is passive and there's no price discovery anymore. And so this was always the argument, and the question really is, yeah, what are the implications? Is it really that dire, sort of, that we're going back to a socialist regime here, or what is your take?
Yeah, that's a really great question. So I'll first off start by saying that I don't think we've ever really had free market capitalism. We'll plant that flag. I don't think that's ever really existed. So it's kind of always been this kind of nebulous concept. In terms of whether or not we're living in socialism right now, I think that's kind of like that exists on a spectrum, right? Like if you look at FDR, like we've been socialist before, okay, and the world was fine. Okay, we've made it, all right. So I don't think that socialism is like this big boogeyman or something that is going to destroy the economy. At many places around the world, and historically it has worked. And I'm not talking about Venezuelan style socialism. Okay, there's plenty of other examples out there where this idea works, but it's a matter of degree. Okay, it always has been, and I think it always will be. Now, one of the things that I want to be very careful about in talking about this is when we start talking about like Marx and who owns the means of production and the relation of capital to labor, all of those concepts are really, I'll say, 20th century concepts. Okay. And as we move through this 4F's phase transition into post-scarcity and into a recursive capital type of an economy, those relationships begin to dissolve. Okay. Like just quite simply, if AI is doing a lot of the labor out there, then the relationship between labor and money and growth and time doesn't mean what it used to, right? If you have a machine that's doing all the work for you, then the wages don't really mean what they used to. Okay, the time that you would put into working for your labor, to earn your wage, doesn't mean what it used to. Okay, let alone the idea of who's owning those means of production doesn't mean what it used to. If you're kind of getting beyond the scarcity of money and beyond the scarcity of time and beyond the scarcity of labor, then you don't have that kind of scarce relationship to the means of production either. Okay. So it's not that socialism is right or wrong. It's that we are moving beyond socialism into something new. This hasn't been named yet. Like the best thing that we can come up with is post-scarcity at this point in time. But this is a very new type of an ism, right? The means of production are owned by something different that we haven't experienced.
Yes, I see. Yeah, and I mean, in the end, it's probably just something that started naturally to some extent as well, like, because coming back to these passive flows, in the end, I think Bogle, the founder of Vanguard, he started it. He could have not imagined that this would probably take the massive scale it has now taken, and it just unfolded itself, sort of. And so it is very interesting to see this, but then at the same time, I think I heard you say or saw you write, that it's also the state that's sort of providing for these capital flows through passive mechanisms, And there I was wondering, how exactly is this working? Like, because again, to me, it's really Vanguard and these sort of non-state actors, who are the companies behind of this, but I haven't seen a mandate that the government is sort of mandating everyone to invest passively and not actively. So
Yeah,
what
no,
are you meaning by this sentence?
that's great. So I think the best way to answer that question is for me to talk about the enterprise-owned state. Okay, so I think everybody's or many people would be familiar with state-owned enterprise, right? You look at China and everybody understands that concept, right? The state owns companies, they own enterprise. Even if we look here in Canada, the state owns the post office. That is a state-owned enterprise. That's a crown corporation, as we call it here. Okay. Um, the idea of an enterprise-owned state kind of inverts that. All right. The enterprise-owned state is where the state itself becomes dependent upon enterprise, on corporations, to that act as a conduit for government policy and distribute government policy and are beneficiaries of government policy. Okay, so it's not quite it's not quite like corporatism, right? Where the government is directing the companies what to do. It's almost the inversion where the companies are directing the government what to do, or at least how to implement policy and how to conduit that policy. Okay.
Mhm.
And the example that I'll draw on there, and this was a very recent one, was a few weeks ago, we saw this big spat blow up between Trump and Elon Musk. Okay, it was very public and everybody read the tweets. All right. Now, unfortunately, Musk has gone and deleted some of those tweets, but I think that that was a really interesting opportunity to kind of peek behind the curtain at how the sausage is made, so to speak. Okay. And what I'll reference one tweet that has since been deleted. But remember when Musk threatened to ground all of the spaceships? He threatened that he was going to ground the space shuttles and effectively there would be no more US space program.
Mhm.
So what does that say about the relationship between state and enterprise? Like the idea that a private enterprise can threaten the government to shut down an entire arm of government policy. And this isn't just communication satellites, we'll say, right? Like this is national security issues. Really speaks to a different form of arrangement between government and corporation, right? So this is an enterprise-owned state. The other kind of thing I'll draw on there is you recall back to the Trump inauguration day, and you look up at the days, like who is up there with him as he's getting inaugurated. These aren't farmers. These aren't teachers. These aren't private company CEOs. These are the CEOs of the U.S.'s largest public companies. Okay. Oh,
Mhm.
and the widow of a casino magnate. Okay. Like, all right. It's like there is a message there. Okay. That these are large, huge public companies that are being integrated into the state apparatus. And that is kind of this new dominant regime. So that is a product of passive flows, and that is a symptom of passive. All right. Like those
Mhm.
companies wouldn't have gone up there if it wasn't for passive flows. But the fact that they are there mean that those passive flows get stronger. Okay. Like the
Mhm.
job of
Mhm.
those CEOs is to make sure that their companies keep growing. Like that is a fiduciary duty. It's like that's what they have to do. And so they have to integrate now into this government policy to remain being the conduits of that flow and absorb the capital from those flows.
Mm. Yes, I see. Yeah, because just thinking out loud here in economics, I learned that there's also something like this economies of scale. The bigger you get, the more prone you are to disruption because like there's sort of this economies to scale. Like at some point, it's just like bad to be big. But you're telling me here now because of these passive flows as well. I mean, these companies might artificially be at the margin at least sustained, through these flows because like. They can sort of compensate for these diseconomies of scale at some point, maybe just because like they're getting more money through capital markets again, which is allocated to them, and that sort of corroborates their position, and makes it harder for them to be disrupted, maybe.
Well,
Which doesn't mean they won't be disrupted, but it's just like another force that's pulling here.
well, I think another angle on that, Pascal, would be like if you think about what disruption means and how companies have been disrupted over the last 50 years, it's been credit market disruptions that have really caused the ins and outs or the cyclical behavior of the economy. But if we're now moving towards this fiscal source of economic growth, which can kind of step outside to a certain degree of the cyclicality of credit markets, well, then you're building a more stable base layer from which these companies can grow, and arguably that makes them less brittle to disruption, right? If fiscal is pumping out money that creates a safety net under the economy, so to speak, and banks can recognize that safety net for what it is, and they recognize that there's a profit potential in that spread between where rates are and what nominal growth is, well, then that creates a very conducive environment for growth that would make things less brittle, right? As long as fiscal can continue what it's doing, as long as we can continue generating more money through fiscal, then that kind of de-risks the rest of the economy and makes things less brittle. That's my.
Yes, I see. Definitely. I mean, it would be really interesting to go deep here, but it's probably for another episode as well. But to
Yeah.
really carve out these, these flows and how they're really happening, from government as well, and that harkens back to the fiscal dominance sort of situation, and how that money is then flowing through to these private corporations as well. One thing that just comes to mind, because I've been experimenting with this, is the Gemini AIs and all the image and video creating softwares out there, the AIs, the LLMs. And so what intrigued me was like Gemini is currently offering like a 15-month free program for students, and I was like, okay, somebody probably has to pay for this, for these AI training credits that are given to students. And it would probably be the universities who are paying for this, I assume. And in Europe, at least, universities, again, would be government owned. And that would then money that would flow through these programs to the AI and big corporates, And so I'm just thinking out loud here. It probably doesn't add up. But in the end, like, it would be so interesting to see how all these flows are connected, and that like even these big companies are probably being redistributed money that you would never think that it's coming from government itself, and is ending up in these pockets, right? I don't know if you have any thoughts on this. I'm just rumbling here.
Yeah, nothing particularly in terms of these like trial programs with the AI idea, but yes, I do see that companies are increasingly on the beneficiary side of direct government spending. I mean, we can see that, and that's happening. I would also say it's not just the companies on the source of the spending. It's also private households and individuals, right? Like transfer payments have been rising. Okay. I think that as boomers continue to age, right? Average age of boomers to life expectancy is another 10 years away. So we should see at least another 10 years increase in transfer payments. And then we have millennials to look at in regards to transfer payments. And we're already seeing increasing use of transfer payments for younger cohorts. I think that if you want to go really deep, look at the 2060s and realize that millennials having less children means that the government will have to step in to support millennials. All right. Like there is a huge amount of support that happens as you get older that come from your children. But if there are no children around, somebody else has to step in to provide that support. And that, in my opinion, that will be the state. So I can only see transfer payments growing from here. As a percent of annual fiscal spend, what is it? Somewhere around 55% right now, 60% is transfer payments, and I could see that number. It's been going up over time, over the decades. We've been kind of plateauing for like a decade and a half, I think, right now, and I could see that number going higher. Like if you're a markets guy like me, you would say that number is about to break out, right? You're about to break out into a new uptrend, and I think that we're kind of on the cusp of that.
Yeah, exactly. That's a very interesting development as well, especially when it comes to the whole Medicare and health segment. I think this is going to increase ever more, and people, who are getting older, maybe obviously we have the longevity trend, and at some point, maybe the millennials who are um, cognizant of this might have some benefits from there. But then at the same time, we have maybe other structural trends that make us less healthy. So again, but in the end, yeah, it's just interesting to see. And I would assume as well, I mean, these transfer payments, they're probably up to the right as well. Just because, as you said, they need to be there to really sustain the system. So, quote unquote, yeah, yeah,
So maybe we'll move on then to the last of the four F's, right? Fiat.
yeah, exactly.
Okay, so fiat is just the idea of a government can print money. There's no tether to a gold standard or any other kind of standard. The money's not pegged to anything. The money is kind of this kind of like it can expand and contract at the will of policymakers. Okay, we can very easily look back to history and say that Nixon closed the gold window in 1971. And what that means is that in 1971, the US dollar stopped being backed by gold. It was then just backed by the full faith in the US Treasury. Okay. So this idea has been with us a very long time. And the first iteration of fiat that we got was that we can expand and contract the money supply at will. Okay. That was a kind of a new development. And that enabled a whole new set of economic responses that policymakers could make in response to economic growth or slowdown. Okay. Now, sorry, and just to really drive that point home, when the economy encountered a very large recession or growth slowdown, the government would create a whole bunch of money that would enter the private sector, and the private sector would put that money to work, and the economy would get back to working again, and we could more effectively and quickly address periods of recession and go back to growth mode, let's say. And that was a very novel and useful development, I'd say, because if you look at the history of inflation and deflation before that, it was all over the map. It was extraordinarily volatile. And I would think that, I wasn't alive back then, but I would think that would have created some kind of different behaviors or incentives if you were a business owner or deployer of capital in that time. And post 1971, yes, inflation has been a one-way street, but we haven't been hit with these massive bouts of deflation, contraction, over and over and over again, the same way we were before that. Okay, so in my opinion, that has been a more preferable experience. I'm sure there are a lot of people that disagree with that. But if you look at why that change was made, I think it makes a lot of sense. Now, where we're going next with fiat, I think, is really extraordinary. Okay. The idea here is that fiat is going to become more programmable. Right now, we can only program it one way. We can expand it and contract. Okay. And on this idea, I'm going to lean on just some recent central bank publications. For example, up here in Canada last week, the Bank of Canada published a paper about how central bank digital currencies, you could actively program them to do all sorts of interesting things. So for example, what if the government issued dollars, but the dollar expired in, let's say, 6 months? Okay. So let's say we did encounter a period of economic slowdown and the government issues one of these 6 month dollars. And so you have to go spend it now. Otherwise, it's not going to be there in 6 months. And boom, you get a big rush of economic spending. Now, the thing that's really interesting about that is if you can change money in that way, then you can do something like eliminate hoarding, right? So one of the biggest problems that we have when we encounter recessions is that all this money is created, but it's hoarded instead of being spent. Well, what if you eliminated that hoarding constraint by making it spendable and you have to spend it in second, right? So that idea all of a sudden introduces a whole new set of tools into the economic toolbox that policymakers can use and deploy to have more direct and possibly stimulative effects on markets if and when slowdowns were to occur, right? This is all towards the goal of reducing the volatility in markets and reducing the volatility in the economy. Okay. So,
go ahead. Sorry.
so I was going to say also that, yes, this was a Bank of Canada paper, and there may be some people in the U.S. saying, "Oh, well, this is never going to happen." But remember that we have kind of entered this world of monopolity, right? So from my point of view, if I see one central bank within the G8 or G7, whatever, writing about a certain topic, you can basically assume that the other central banks are also thinking about it, right?
Mm.
Because if you see in the direction of policy over the last decade or two, it's towards monopolity. It's kind of a one policy amongst the developed markets, and they're all exploring various aspects of that.
Mm. Mm. Yes, I see. No, no, for sure. That's also an interesting observation, so to say. I mean, I want to critique some of the things that you were saying, with like obviously general points of criticism that people would probably level at this. But maybe first, I want to ask, why did this regime change now really become or is now underway? Because it feels like, as you said it yourself, Nixon closed the gold window in 1971. So this been 50 years now since it's closed. Why hasn't it started earlier? When did it actually start? I think you said something about in the 2010s or something. And then why was the pandemic also accelerating this? And why is it now that this is it because of this confluence that we're seeing that everything is coming together now? And before we only had like individual parts of this, or yeah, why is it happening now?
Well, I think you absolutely nailed it there, Pascal. I mean, we have seen various aspects of this through history, and we have seen various aspects of this in other geographies through history. But now we are living through a very unique time where all these things are coming together concurrently at the same time, and we're all living through them in the here and now. I would say that there's an aspect of this that could be called emergent behavior. Like this is just, self-organizing criticality around certain points. You could even make an argument that this is a very purposeful idea in the form of leaning on some of the, accelerationist ideas that have become more popular, I'd say, over the last 5 years. Let's say post-pandemic, you've had a lot more people interested in accelerationism and this idea of moving towards this kind of eventuality of post-scarcity and AI. I mean, I think another part of this would just be that, well, we finally have the technology that can make this possible. I mean, ChatGPT is only like 2.5 years old, and look at what's already happened, right? Robotics is just kind of like an iteration of capitalism, right? If you look back at the earliest form of tools, like the plow, you could, in a certain sense, say that was the earliest robot, and the plow is what? Like how many years? I don't even know how old the plow is, but just to use that example that we are progressing more because through our technological innovations as well, that helps us happen, right? And we are kind of now coalescing around this point where we have all the elements that we need to really deploy AI across an economy, right? We're finally at this point, and it's not like a light switch. It is a gradient, and we are moving through.
Mm. And why was it accelerated by the 2010s? Was it because of the great financial crisis that would have taken the entire system down, and that's why they had to go full fiat? Let's put it this way, and pull all the hats
Yeah,
or
I
all
mean,
the rabbits out of the hat, or yeah.
like if I recall back to the global financial crisis, it was an all hands on deck moment. It was an economic reckoning. It was, it was staring into the abyss. Policymakers had a choice. You either inflate or you enter a depression. And you never know when you're going to exit a depression. But if you inflate, at least you're doing something. Okay. And I think that has also kind of set the stage for policy since then. The preference has always been to inflate your way out of it. Right. And I think a product of that has been that we haven't had a meaningful recession since the global financial crisis. Apart from the COVID recession, which arguably lasted like a couple months before everything was okay again from like a GDP perspective. Okay, that absent COVID, absent that COVID recession, would we now be in a continued phase of economic expansion since the global financial crisis. That would have been unprecedented. We never would have, that is just not something that exists in the economic record. And so without a kind of exogenous shock to the system, and certainly that could happen, can this current mode of economy keep going the way it is, right? We have maybe stumbled upon something, or maybe this has been an emergent behavior, or maybe this has been led by a group of, ultra smart policy wizards somewhere. I think that's a very hard kind of thing to pin down. But the point is that it's happening and that we're currently living through it. And what it means next can really, like where that acceleration goes next is kind of, that's the real purposeful part of this. We now made it through a lot of the hard transition phase, I think, and we're getting closer to the point where we turn the machines on and we let the machines start to run.
Yeah, I see. I mean, now moving on to the criticism, I think some people would argue that we haven't made it through this sort of initial phase yet. We're not out of the woods, and something could still come our way that could really knock us down again, and so I want to approach this from a big picture perspective first, because the two main criticisms that I would hear and would really be, well, is recession, is it really a policy choice now? Is it just like we can either implement the policies and then we can fend off or ward off a recession, or if we don't do the policies, then the recession would hit? And some people would probably remind you of this Ayn Rand quote where they would say, you can ignore reality, but you cannot ignore the consequences of ignoring reality. At some point, it will really hit you in the face, and then the volatility will really burst out again, and we will have it, even though it must necessarily be something from the outside, So that would be the first criticism. And the other one would be about the thing that you described, in terms of where we're moving with the central bank digital currencies potentially, where we can really start program fiat money. Isn't that also somewhat dystopian then, And so maybe you can tackle these two questions separately.
Yeah, sure. I've definitely encountered those arguments before. And look, I think they're great arguments. I totally understand why people make them. But I do ultimately think that they're not all they're cracked up to be. So in terms of recession being a policy choice, I do believe that. I think that at this point in time, policymakers have a decision. I think we kind of just almost covered that in a way where when you encounter an economic slowdown, you can either let that slowdown happen and you can do the austerity thing and you can force your population through hardship, and then you can not get elected. And then some other person will take over that promises these people everything. And then that person goes on to run things. Or you can just kind of shortcut that system and you can be the person that promises these people everything. You can increase spending and you can stay in a position of power. Well, I mean, I think the choice there is pretty clear from a policymaker perspective. I think that the fiat tools are what enable that to happen, right? So, the ability to expand the money supply as a policymaker is the recession policy choice, right? You can either choose to do that or not. And I think the global financial crisis is the preeminent example that, yes, this is something that should happen and will happen. And I would even go back to lean on the 2020 example, right? Where when we went through the lockdown, right? And policymakers chose to print a whole bunch of money. Okay. Not only that, but then you also had the Fed chose to buy a whole bunch of corporate bonds, right? Like these are all policy choices. Okay. There wasn't some yes, there was an exogenous threat to the markets and to the economy, but the policy choice was made to counterbalance that. Okay. And I think that that's still the framework that we're in, and that's a framework that we'll continue to be in. Now, the second point that you made there about central bank digital currencies and some sort of dystopian future, and maybe you even want to throw in surveillance capitalism into that. That could be one way that you want to look at it. But the other way that you could potentially look at it is what if policymakers had a more effective set of tools with which to enable policy? Like, what if the trade-off there meant that you didn't have somebody that was hoarding all the assets when that money was taken, right?
Yeah.
I think that a lot of the criticisms around these topics, they're not just like one point of contention with the topic. It's kind of like a host of criticism around an ideology that is being expressed. It's not that one thing is the problem. It's that what that one thing represents as an ideology is the problem to the person expressing criticism. And so I think that itself is still rooted in this kind of 20th century idea of looking at markets from a capitalist point of view, a communist point of view, a socialist point of view. Keynes, Hayek. I mean, those are all very, very 20th century's ideas of looking at the market. But and it's not that they're wrong, it's that they just no longer apply for where we're going next, right? And so it's very tough to criticize something when you don't really know where we're going next to it. Okay?
Yeah. No, go ahead.
I was going to say one other big criticism that I encounter a lot, and this is more on the passive flow side, is the whole idea of market valuation. Okay, so I did want to just really quickly touch on that, where you get a lot of I get a lot of criticism with that idea that, oh well, the market's set like 30 times earnings, that's historically very expensive, and therefore the market should stop going up, right? And that's kind of the end of that argument. Well, one thing that you got to keep in mind with that is that when you're saying that the market's 30 times earnings and you're comparing that historically to where the market was before, the market today has never looked like it did before. Like if you rewind 20 years ago, the market was like energy companies, industrials. Today, it's, effectively 7 very large technology companies. So it's an apples to orange comparison. You can't just take what's being earned today and map it back through history, because it just doesn't apply. The market looks very different today, right? The second point that I'd make there is that if you want to look at it from a fundamental perspective, those 7 companies have grown earnings by like 30% year over year. The rest of the S&P 500 has grown earnings by 9% year over year, right? So if you're going to pay 30 times earnings and the S&P 500 has grown earnings by 30 times, I mean, if you want to do the whole PEG ratio thing, that's 1-to-1. I mean, that's not cheap. Certainly not expensive, right? It's kind of like middle of the road. And so from a valuation perspective, I don't see the markets as being expensive right now because those Mag 7 companies are growing so much. And because I don't see anything that would interrupt that cash flow in the near term, then I don't see why that would be an issue right now, right? I think for a lot of people, they don't really understand what a PE ratio is, right? It's really just a short form for a discount cash flow model. And the discount cash flow model incorporates, you have to look at the growth rate of it. You can't just look at what's the terminal model. You have to look at how fast are these cash flows growing, not the terminal model, the discount rate is what I meant to say. You have to look at not just the discount rate, but how fast are the cash flows growing. That's a really, really important thing when you're looking at high growth companies that are dominating. So that would be kind of the other big criticism that I tend to get on that flows question.
Yes, I see. Yeah, I was going to ask this as well, but thanks for preemptively already answering this. But I mean, in the end, yeah, I find this fascinating. All the arguments that you're putting forth, and I can also really follow it. And I feel like, okay, from a descriptive sort of point of view, I would even argue this is so close to how reality really works. In the end, what I haven't made my mind up about is really like on the philosophical grounds, and obviously at some point, if you are a pragmatist, it's maybe philosophy isn't really what we should care about, but there I'm still sort of struggling with the idea, this, because you said you understand it yourself, like the arguments that this could all be dystopian if you really have like people who can then just through the correct policy choices make sure nothing ever happens again, and the question is then to me, okay, but what are the consequences, because I feel like there must still be consequences to each and every action, and even though maybe everything can be nominally upheld, and that I think that's what you're arguing as well, in terms of growth, in terms of also financial or fiscal credibility and everything. But then what are the real consequences? Aren't there any real consequences that are sort of also then bad in that sense? For example, maybe just one thing, if there's less efficient capital allocation, yeah, then the market prices might not work that much anymore, or the asset prices going up. Is it really like the inflation that's hurting people then if you're not exposed to these assets, and that it then increases societal polarization, or what are the bad consequences? Because I feel like if you can nominally uphold the system, something has to give somewhere else, and maybe it's not that the whole world is going to shit, but what is it that is maybe not as good about this?
Yeah, sure. So I do think that in a very real important way, post scarcity can help address the inequality problem that's been with us for a very, very long time. All right. One way that I think that this ends up happening is if you look at the plight of millennials right now, who have been effectively shut out of housing affordability and who have instead now taken to crypto and passive index ownership in order to build wealth. But even on those terms, the relative wealth gains are not where they used to be in terms of other generations, right? So what do you do to fix that, right? There's that very famous email exchange with Peter Thiel and Mark Zuckerberg at Meta, where they're talking about the disenfranchisement of millennials from the capitalist system, right? Well, how do you fix that? That's inequality at its core, right? How do you fix that? Well, if you can give asset ownership, if you can provide asset ownership to a wide range of the economy, to a wide range of the private sector, well, then does that help overcome that specific problem, right? And so I think that in a way, when we hear these policy proposals of giving every single baby born, a stake in an equity participation stake in North America's largest companies, well, is that not kind of attempting to fix that problem? And is that only you could only get to that point if you had the 4Fs framework from which to springboard off, right? So I do think that this is at least an attempt to help fix that inequality problem. All right. So I see this being as more of a solution to inequality and not so much as an exaggerator of inequality, right? Mm-hmm. Particularly if you can get into a place where you introduce new financial instruments that would prevent hoarding, right? Like if you can issue a central bank digital currency that is non-transferable, right? So imagine you get $1, but you can't spend it somewhere else. You can only spend it on a certain thing. Okay, yes, that's a form of control, but also it means that dollar cannot end up being hoarded by somebody else. That helps prevent an inequality problem. You can still execute on your spending objective as a household or an individual, but it means that dollar cannot be hoarded on the other side of that spend. Okay, I think that's kind of a very new thing, and a flip side to the CBDC, if you will. Okay, now the other thing that you asked about in terms of consequences, and I think this is a very, very real one, and this is something that I am on alert for, and other people I think should be on alert for, is that as we transition into a new phase of an economy, these old economic metrics will start throwing off bad signals. Okay, so what I mean by that is, we already had a very good example of that in looking at the yield curve, right? This is a very simple heuristic. The yield curve just looks at the various maturities of treasury debt. And historically, when that yield curve was inverted, you would enter a recession. Okay. Now that's because of the way the economy worked over that period of time. Because the economy doesn't work that way anymore, that yield curve signal doesn't work anymore. And yet people still gravitate to it because they've had this kind of training on it. Okay. So that's something that you got to watch out for here, even to the extent that AIs might have trained on data that is no longer relevant. Like AI is not some panacea that fixes everything. The AIs themselves may have to be retrained on certain economic concepts. For example, yield curves doesn't matter. Even the Fed, again, last week, the Fed put out a paper that examined the historical accuracy of AIs. And what they found was that the AI was very good at very recent data, but as it went further back in time, it became less accurate at what it was saying about the economy. So we really got to watch out there that the AIs are a fantastic tool, but they have to be trained and monitored properly. Okay. Another thing that we might want to be on the lookout for is things like the unemployment rate. Okay, like if we are moving towards post-scarcity and we have AI that is replacing the bottom end of workers, let's say, right? So right now in the U.S., college graduates with a bachelor's degree between the ages of 20 to 24, we're seeing a gradual rise in unemployment. Okay, it's not quite at critical levels like it has been historically, but it is rising. Okay, is that happening because AI is replacing those jobs? Right? We don't quite know that. It could be because immigrants are self-reporting as being unemployed, and in this recent wave, immigrants have skewed younger, and in this recent wave, immigrants have also skewed to having more bachelor. So maybe that's throwing off that data, but it also could be because AI is replacing those workers. So that's something that we have to watch out. So there's a number of these things that policymakers should have to watch. And if they don't interpret those signals correctly, then the consequences could be dire, right? Then you end up in a place where the machine stops working the way it is currently working right.
Mm-hmm. Yes, I see. Yeah. I mean, two things that come to mind, and I'm still keeping with the criticism part here, is like one thing would be obviously, because that's an argument I heard MMT people make before, that they're saying, okay, the way growth has been created so far, has been through private bank lending, and that's something that you alluded to as well. And this obviously enriched a whole class of bankers along the way, because in between, they were the ones that were intermediating these credit products and stuff. And so they took out their fair share and maybe sometimes too much. And that's why they were sort of artificially benefiting. Now, if this is really falling away and you have Fiscal taking over, then maybe it's no longer them, but maybe another class of people, maybe the ones closer to government that will profit. So the question is it really going to be fair in that sense, or is it just another class of people who are going to skim off the profits and really have it for themselves? That's maybe one argument. And maybe the other one, let me make it real quick as well, is I feel like from the 4F regime that you're describing here, to me, it feels like, okay, a lot of things can be controlled for, as I said, no longer recessions and everything. And it really seems to make sense, but then it's all at the cost of more control. You really have to control your populace. You have to make sure they're not hoarding. And I just want to quote this one psychology professor that we quoted in our book, that we were writing, because we were talking about these CBDC things as well. And there was this one quote that stuck with me, where he said they did some studies and they found that having a strong sense of controlling one's life is a more dependable predictor of positive feelings of well-being than any other objective sort of condition of life we have considered, And this is something that maybe we get into a world which is no more recessions, everything is controlled, but the people who are not feeling that they have the freedom anymore and just are being controlled by the apparatus, they are then sort of feeling ever more depressed. It's just another thing that I want to throw at you. Maybe you have some thoughts there as well.
Yeah, I've definitely thought about that. I think that's a very real issue that has kind of really, unfortunately, become one of the dominant themes of our time, right? But the skyrocketing rates of depression, and I think a lot of that may be related to these ideas of control, right? So let me reframe it for you this way, where if we are progressing towards post-scarcity, and if we are progressing to a world where AI increasingly automates labor, and the relationship between time, labor, and money become dissolved, right? Those things are no longer scarce. Then is there not a sense of control that is being gained by someone who would otherwise have to go to work at a job that they may or may not like or may or may not want to be doing? What if instead that person now had more free time and they could go care for a loved one instead? Would that not be more of a sense of reward? And would that be an acceptable trade-off at an economic standpoint to hand over a certain amount of control over the production of goods and services towards AI so that humans could do more of the human stuff that, after all, makes us human to begin with? And so for some, yeah, that's a loss of control, obviously. For others, that's a gain, I would argue. And that is going to be messy. That is not an easy transition. That has a very deep implication, leaving this mode of production, right? But I mean, look at the course of human history. We've made it through all sorts of different economic forms of organization, right? It's not like that stops the capitalism. There's that very famous quote that capitalism, I can't remember it exactly, but it's the Mark Fisher, and it's something like, capitalism can't imagine anything beyond itself, right? Well, we're going to have to start imagining what that looks like because it's coming and it's going to happen, and it will change how we think about the idea of control and what we have control over and what's worth having control over. Now, the other thing that you mentioned there about, do economic gains accrue to the people that own the AI and control the AI? I think that where we're at right now, yes, that is the case right now, that the economic gains are flowing to those people, right? Now, does that change? What does that look like if you have agentic AI CEOs, right? So that would be the case where the CEO of a company is itself an AI agent, right? Right? Like, does that, do we allow that to happen? In which case, does that capital accumulation just flow to that AI? And does that even matter? Because if you're already living in a post-scarce world where you don't have to go to work every day to pay for your food and your shelter, et cetera, like, do you even care that all that money is going there? That money is no longer, that money no longer holds the same meaning that it does today under an industrial capitalist, right? The very definite and the meaning of money changes in such a way that maybe it doesn't become such a focal point for the human existence as people think about it today. So from a philosophical perspective, I would agree with you that that is an issue right now, and there's no easy answer to that. But if we can make it through this, and there's this kind of new phase of what the economy looks and how it operates, then maybe the answer is in that transition.
Yes, exactly. Yeah, these are some interesting points for sure as well. I mean, you referenced this post-scarcity world already, and you were just hinting at it, that the time, labor, and money connection might be disrupted or broken by this post-scarcity. How will this happen? Can we maybe flesh this out in more detail as well? Like, what will money look like in a post-scarcity world? What will work look like? Or maybe even then, what will time look like, in this world?
Okay, so now we're getting into more financial science fiction, which I absolutely love, but I just want to put out that this is all very speculative, and this is just having a bit of fun about what the world could look. Okay. Of course, as an investment manager, you have to remain adaptable to play the world as it looks. But if you take these ideas and you kind of project them forward, what does the world look like given where we're at today? Okay, so first one you asked was about what does money look like, right? And so I think that the transition, if you're dealing under post-scarcity economics and you've dissolved that relationship between time, labor, and money, then money just kind of becomes this thing that ends up coordinating flows. It's no longer like a stored unit of account. so to speak, in the way that we traditionally thought about it. It's kind of just like oil in a car engine, right? It just makes sure that everything keeps running the way it is, and it's something that you can exchange almost like a token, just to keep track of the flows, right? Because remember what I said at the very beginning of this: the flow is what matters, right? Money doesn't care where it comes from; it just needs to keep flowing. That's what keeps the economy moving. So that money is basically just this thing that keeps moving around an economy, that keeps everything going. Um, can you remind me what was kind of the other the
The
other?
labor and time in the end.
Yeah.
How will
Okay.
this be disrupted as well?
In terms of labor, right? So I think I actually may have just touched on it in terms of the consequences question, where um, if you don't have to go to a job every day, you can still do something you love. If your job, if you're doing what you love, I mean, by all means, probably keep doing that. But there are probably a lot of people out there that aren't doing what they love, and maybe they would enjoy doing something else more. And so if you were to live in a world where, maybe not everything is, I'm not talking about like automated, like luxury communism or anything like that, like this is not the idea here. The idea is that there's still some sort of an incentive to go out there and do something that's valuable for the economic system. Maybe the thing that you're doing right now is valuable in this current economic system, but won't be in the next. And so there is still purpose for doing what you love. It's just maybe that the wage compensation aspect of it isn't the same as where it is today, right? So providing care for loved ones, even your own loved ones, is incredibly economically valuable. Okay, making sure that humans are surviving through all sorts of the ups and downs of humanity is incredibly valuable for everybody. Okay, um, um, going through AI training data sets and making sure that those data sets are correct, that would be incredibly economically valuable under a post-scarcity world, right? So there are still places to deploy labor, there's still places to deploy your time, but just that relationship between those two concepts is not tethered in the same way that it is today, right?
Mm-hmm. Mm-hmm.
Uh, what if we even move to a system where it's AIs that are saying, hey, you know what, today it would be really great, Pascal, if you helped us with this problem. And if you have some time today to help us with this problem, maybe you get some extra participation credits or whatever you're calling money that day, or maybe it's space credits, whatever, like there is still some form of resource allocation happening. But the point is that it's not the market deciding the resource allocation. It is an automated direction towards that resource allocation.
Mm-hmm. Yes, I see. Okay, I have to think about this in more depth for sure. But I mean, you had this post, I think, and it's a reference to this as well, where you were referencing Thorstein Veblen. I think
Yes.
the economist, sociologist, from what I took there, it almost feels like that influencers, the social media influence, maybe also the podcasters, people like you and me, who are doing this
Yeah.
now. They are the leisure class of the future. They are already a glimpse into what the world will look like, because we're also redirecting flows already in terms of like attention, in the end through a sponsor maybe, and that's how it works. But from other people outside of this realm, who are not so familiar with this new world, I'm usually hearing the argument, what are you doing? How are you earning your money? Are you even working for real? Is this real work? And so maybe you can expand on this as well, on this idea, because I found it fascinating as well.
Yeah, I thought that maybe you would have a real like instinctual understanding of this idea, because you produce a really great podcast, right? And influencers will kind of naturally understand what I'm talking about here. And if you're not an influencer, or if you think that the whole concept of influencers is silly, then I think you should really pay attention to what I'm about to say next. So, Veblen wrote this book, The Theory of the Leisure Class, which explained how under industrial capitalism, what is the function and meaning of being elite, right? And the way that he saw this is that elites spend their resources on wasteful objects, and this is purposeful. It's conspicuous consumption. So the idea is like, there's all sorts of things that you could point to. Why do you drive a high-priced car versus a regular car, let's say, right? Like that would be, that's kind of part of this idea, okay? And that elites consume conspicuously, they consume resource in a conspicuous way and wastefully in order to demonstrate what elite status means. And then the rest of the people in the economy kind of look at that as a model for how to behave and what does elite mean. Okay. But if you start dissolving the links between time, labor, and money, then then elite is going to start meaning something different, right? Particularly on the money aspect. So borrowing from Veblen's idea, you need to spend resources wastefully in order to demonstrate an elite status. Well, what is the most wasteful form of spending that you could imagine under a post-scarcity economy? The answer is attention. Okay. So if you can spend your cognitive bandwidth, if you can spend your own attention on things that don't matter economically and that their only purpose is narrative, well, that is the new form of wasteful spending. That is your new way to demonstrate elite status. And you push forward that narrative message towards your audience of something that is aligned with system goals, right? So, for example, in this circumstance, here's you and I being influencers talking about what happens next in the world of AI, right? So we are pushing forward this message. This is a message of elite status, right? And I think that the world is going to start looking a lot more like that. And we're going to have all sorts of different influencers and all sorts of different aspects of what post-scarcity means. But this whole influencer thing is not going away. This is the new production of elite status in the new economy.
I see. And connected to this, maybe this one question, because if we are really moving into this world of post-scarcity and it's sort of the la land, where all the resources are around. The question that I'm having then, because as a child I learned if I am in la land and everything, is just here, all the fruits, nothing has value anymore because everything is already abundant. And so is this still then like my podcast, me being then one of these influencers maybe who does a great job and is part of the leader class, so to say, the new one? Is it still valuable and will assets still sort of command some sort of monetary premium, or will this all be gone? So help me think about this as well.
Yeah, sure. So first I want to dispel the idea that this is going to be some sort of la land. Like this is not automated luxury communism. This is not abundant and free everything, right? There is still work that has to be done. It's just that we're letting the machines do that work. Right. So there are real constraints. There are real resource constraints. There are very material constraints. Like we have to make sure that we can source the rare earths, et cetera, that we would use to build these technologies. Right. So this isn't a world where everything is just free and abundant. It's just when I'm talking about post-scarcity, the thing that is no longer scarce is time, money, and labor. Materials are still scarce. We are living in the boundaries of this world, right? But if we could, for example, do you take a very recursive capital idea where let's say we could build a robot, and that robot builds other robots. So we start, exponentially building robots, and those robots, and you take half of them and you tell them to go get the rare earths, and then you take some of the other robots and you tell them to drive those other robots to go get the rare earths and back. Oh, by the way, then you take another group of robots, you tell them to build the solar panels that go on top of the robot building factory so that there's this kind of like energy loop that starts happening where the solar energy builds the robot building factory and everything kind of becomes recursive and self-referential. That's kind of the idea here. But we're still bounded by the real constraints of the world. Okay. And so from that point of view, things will still have value. Things will still, there will still be a connection of value to things. I just don't think that value system will be driven to the same degree by money as it is today. I still
Mm.
think that we will find other ways of humans for humans to express value. And I think humans are incredibly good at that. That is a very human thing, is to find value in things, even though they don't have price tag on them. I just think that making that more of an explicit kind of purpose for our society could actually be very helpful from where we've been through recently in terms of the ideas of inequality and all that type of
Mm.
thing.
Yeah, especially like if then like real human work, like if work is not something that what we need to do, but it's really something that we want to do, then maybe it almost becomes this luxury, like handcraft today, even though we can produce so many things, yeah, just through mass production, like a real handcrafted maybe desk has a lot of value today because people feel like, okay, there has a lot of work has gone into this, a lot of dedication, and this is sort of a luxury that we have. And maybe at this point, then maybe caring for the elderly or for other people will carry a lot of value because it's really done by an actual human being and not by one of the robots or humanoids or whatever. So this could command value for sure as well. I mean, one thing that I would ask you is can we dispel the myth for all the Bitcoiners that are probably listening to the podcast that their Bitcoin won't just go to zero in a post-scarcity world because yeah, it might still carry some value. Yeah, you had an interesting theory there as well. Like Bitcoin, it might be more for the time aspects in ordering, chronologically ordering time, through a ledger and not the money aspect. So maybe if you could spell this out as well, that would be
Yeah,
interesting.
yeah, I'd be happy to. So this one gets a little deep and philosophical, but the idea really just highlights and almost exaggerates what Nakamoto initially wrote in the white paper. When he's talking about Bitcoin being a chronological ledger, um, that is effectively one way to think about time, right? So if we go back to human history and you look at the birth of industrial capitalism, we had church bells that would ring that would tell us when to wake up, when to eat, or sorry, when to work, when to eat, when to pray, and that would kind of organize your day. And humans, this is very like Kantian, like the philosopher Kant. This is a very Kantian kind of view of how time works, and really the human relationship with time, and it's very much of a subjective thing, right? The fact that it's like 11 a.m. is a very human kind of an idea right now. If you move to a world of post-scarcity where AI is making decisions in rapid order, does it really matter that one decision was made a millisecond or two, or even a shorter length of time, a nanosecond, before the other one? I mean, at a certain point, it becomes indistinguishable because machines operate on such a different scale of time. So what I'm arguing here is that the thing that captures the chronological order in a way that's immutable, in a way that's referential, is crypto. Okay, so I think the actual use case of crypto may not be that it's some sort of store of value, etc. I think that the actual end use case for crypto may simply be that it's a way for AIs and robots and machines to organize chronological events so that they can keep track of what happened and when, and use that information to make decisions in the future. So that doesn't mean that it's Bitcoin versus everything else. That means that everything, all these different cryptos and L1s, et cetera, they all have a purpose, right? You may need some sort of one of these may have to operate as kind of like our version of GMT time, like Greenwich Mean Time. There is a foundational like 0 o'clock in London, right? And maybe that's what Bitcoin becomes. Maybe that Bitcoin becomes that foundational time off of which all the other crypto can reference. But it also means that maybe we have thousands of new crypto emerge, and each machine kind of uses its own crypto to keep track of its own chronological history, and what happens next.
But why is it important to keep this chronological history, so to say, And obviously to know that one thing came before another thing, but like concretely speaking, how would this really help us in a post-scarcity world? Sort of what benefit would we get as humans out of this, or is it just the machines, or like, can you flesh this out more concretely?
Yeah, so I think it was actually highlighted in that Fed paper from last week, where the Fed went back and it looked at economic history, and it was able to determine that the most recent events were being accurately recorded by various AIs, LLMs, I mean. But the further back in time you went, the less accurate it got. And maybe that's because those events historically weren't being recorded in the same way that they are being recorded today in a more rigid, immutable format, which crypto represents. So I think that if it essentially creates a paper trail, right? And if you start paper trailing the production of goods the entire way through a supply chain, and you could get incredibly granular in terms of how these machines were operating, I think that there would probably be value in that. I mean, who's to say? Like, there are people that would probably far more expertise in how these systems actually work. But I could see a case being made that having that enabling machines to access a paper trail of their own production history would probably be beneficial if you were going to use that as training data from which you could, make decisions about future production.
Yes, I see. Okay. Yeah, definitely something I have to think more deeply about as well. Well, I think we covered a lot of ground here in almost 90 minutes or even more already. But I want to bring this to a close then with maybe some practical tips for investors. Maybe we go back to the here and now, and we're in this regime shift that we really carved out and you really fleshed it out for us as well. So like, how should a investor now like really play this or move along while this regime shift is happening, and also maybe what are the preferred indicators to track maybe these fiscal flows that you were mentioning, or what's on your radar there?
Yeah, sure. So I think in terms of the very practical application of these ideas in terms of today's investment world is you got to be very careful about owning bonds. I think that owning bonds under the conditions that I just described under 4Fs could be somewhat complicated, let's call it, right? I personally don't own any bonds in the portfolios here at this moment in time. I just don't see how they would be applicable under this circumstance. The other thing that I'll mention is that given everything that we just talked about, the way that that I'm managing money here is entirely systematic and rules based. Okay, so the way that I see this is that this is all a narrative that explains why the rules are doing what they're doing. This is not me imposing kind of my philosophical view on what investments should do. I think doing that, it could be very, very difficult for investors. So if you start taking these ideas and you use these ideas first as a filter through which to make investment choices, that could end up being very difficult. If instead you look at a very simple rules-based investing framework, and then you try to use, and then you look at how the narrative comes out of those rules, so you have to invert that process, you could be a lot more effective in your investing. Now, in terms of equity markets, I think the idea of the passive flows dynamic is very, very strong. So I'd encourage investors to have a look at looking particularly at Mag 7 companies and the degree of cash flow growth happening there, and how that is radically different from other times in history, and what that means about the valuation question that we covered today. I would also encourage investors to look more from a trend following point of view and not from a mean reversion point of view. I think that mean reversion is an investment technique that could be deployed more effectively by more professionals. I would say that you really have to you really have to have your finger on the trigger in order to make those calls in this type of environment. As opposed to trend following, which is just simply, like own the things that are going up, it's an easier way to make sure that you're on the right side of these ideas, right? And particularly if something's not going up, maybe it's not a good idea to own it. I mean, every investor has their own objectives and their own kind of way of looking at things. But as a general rule, if something's not going up, it doesn't really make sense in this world anymore, where things are moving away from the mean. The trajectory is moving away, not back to the trend.
Mhm.
So those would be
Mhm.
the two big ideas I'd encourage people to look at.
Mhm. And what about gold and Bitcoin, for example? These because in that framework, it would sort of be the antidote, or still like the old world thinking. People that are sort
Yeah.
of hatching on to this post or post scarcity world. And I could imagine that, at least for the time being, there will still be quite a lot of people, especially my friends and probably some of the listeners here as well, who are saying, well, if this is really true what he's describing here, this 4F regime shift, then I have to own gold and Bitcoin, because like he's exactly describing the dystopian world that I've always think it's going to happen. So wouldn't that be also a play, gold and Bitcoin, just because this tribe of people is never gonna go fully extinct, so to say?
Yeah. So in terms of gold, there's a very large allocation to gold mining company in the portfolios that I manage. And it's been there for quite a long time, and it's been a very successful trade. Um, I do think that part of the gold trade is not just its role as it started off as an inflation hedge, right? And then the meme kind of changed that it was kind of this like defensive antidote to trade wars, and even possibly like a Middle Eastern conflict. And now it seems like, now that the big beautiful bill is kind of going to happen any day, that it might be going back to an inflation meme again. So I think that despite whatever meme value it has, the fact that gold has been going up the way it has warrants every investor's attention. That's may or may not continue into the future, and so you have to remain adaptable. Like I said, if it starts going down, then maybe that requires investors to take action to do something about it. But at this point in time, it is one of the strongest trends out there that I've been watching and participating in. In terms of crypto, um, yeah, I mean, like that's something that has been going on in an uptrend. Now, because of crypto's volatility, it may not be for everybody. It's not the perfect fit for every investor. You obviously have to weigh that in regards to that investor's risk tolerance, their investment objectives. That being like, crypto, if crypto moves up and down like 20%, particularly if it goes down 20%, can you handle that? I think that's still an open question for a lot of people. Now, one thing that I've been seeing over the last few months, since my views have been getting shared by a lot of people now, and I'm interacting more with people on Twitter, for example. One interesting thing that's been happening is now I have a lot of crypto people who are DMing me, and they're saying, and it's actually very interesting. These are people who have like they made generational wealth on crypto, on various kind of tokens and coins and whatever. And they've been reaching out to me, not so much about investing more in crypto, but about de-risking their portfolio. So one of the interesting things I've seen is that now that crypto is going mainstream, it's not so much that TradFi people are doing more Bitcoin. I think a lot of this is crypto people are starting to do more TradFi, because I think that um, there may be this like natural human inclination to kind of de-risk after making, 7 or 8 figures when you weren't expecting to do it. And now that you're there and you may have a young family to look after, like there are people that are reaching out to me that are like, retired before they're hired, so to speak, and it's like,
Yeah.
that's a very real kind of decision that you have to make if you're under the age of 40, let's say. So, so crypto, I think, is a really important asset class. You have to be looking at it. If your financial advisor is not familiar with crypto, and I'm not just talking Bitcoin, I'm talking about like the entire space. Like if you're not familiar with how this works or what's happening, I think you need to find a new financial advisor, because that's only going to grow. It's not going away. It's only going to become more integrated in the financial system. But more broadly, gold, Bitcoin, equity markets, the things that I would emphasize there are that, um, you know, looking at things that have fixed supply where you can't make more of that, I think that's still a very relevant investment theme today.
Mm. Interesting. Yeah. And I can totally second what you said. Me working at the bank, we see this as well. Like it's really the institutions flocking in right now, who are taking over the baton of investing into crypto, while a lot of these early OGs and people are taking some chips off the table just because, as you said, they've made generational wealth and they want to now maybe enjoy some of it. So that's certainly something we're seeing as well. So, Ben, yeah, thanks a lot for doing this. That was great. It was definitely this all touch every topic episode, that I wanted to do with you today. There's certainly a lot of places where we would have to do or where we need to do some more deep dives with some of the special topics that we touched upon. But I think as a first overview episode, this was great. Thanks a lot for taking the time. And yeah, looking forward to talking to you again about all these very fascinating topics and definitely some of the beliefs that are being challenged here. But that's what I like. You always want to be challenged, so only then you can sort of progress and advance. Yeah.
Yeah, thank you so much, Pascal. It's been a real pleasure. And look, to everybody who's watching this, with your feedback, and I would absolutely love it. If you think I'm wrong, please tell me why. It's extraordinarily helpful. If you give me feedback and you think I'm wrong, tell me why. If you think I'm right, tell me why. It's going to make my day. So please make sure you comment, like, subscribe, whatever. It's. I would absolutely love to hear back from everybody who's watching this.
Great. Cool. Ben, thanks a lot. Have a great one.
Thanks very much, Pascal. I'll talk to you later.